I was ready to close the charts and walk away from the markets for a few days until one price from China hit my screen and stopped me cold. The number looked so crazy I checked it 3 times. Silver trading close to $80 an ounce in China, while the rest of the world still thinks silver is worth about $25. That is not a small mistake. That is a hard signal that something deep in the global system is breaking right now. When a boring metal suddenly sells for 2 to 3 times more in one country, it usually means someone has lost control of real physical supply, and a squeeze has already started in the shadows. If you hold silver, mining stocks, run a business that uses silver, or even just keep savings in cash, you need to see what this data is saying before the rest of the crowd wakes up. So pause what you're doing, watch the story to the very end, and decide for yourself if this is the opening scene of the biggest silver move of our lives. And if you want more of these deep, no BS breakdowns, please subscribe, hit like, and share this video. It really supports the channel and keeps you ahead while this plays out. Something is clearly broken in how silver is priced in China. While global spot prices sit around, say, $25 to $30 an ounce, buyers in parts of China are facing offers that work out closer to $70 or even $80. That is not a small premium. It's a deep crack in the global price map. In normal markets, such a gap would quickly close. Traders would buy silver where it is cheap, ship it to where it is expensive, and lock in profit. This process, called arbitrage, usually acts like a zipper that keeps prices around the world almost shut. Today, that zipper looks jammed. We have seen similar fractures before. During the 2020 pandemic shock, gold in London and New York briefly traded at very different levels because flights stopped and bars could not move. In nickel, in 2022, a short squeeze drove prices on the London Metal Exchange far away from the real physical market until the exchange simply canceled trades. The key red flag now is that this Chinese silver premium has lasted longer than a short shipping delay and is growing, not shrinking. If this were only about freight or customs, the spread would likely ease with time. So what is blocking the usual flow? Are warehouses emptier than reported, or are new buyers quietly taking everything they can get? Like a bridge with one missing support, the structure can stand for a while, but the stress lines are obvious. If China's price fracture widens further, it could pull the rest of the global silver market out of alignment too. In theory, the paper price of silver and the price of real bars in your hand should move together. Futures on COMEX and quotes in London are supposed to reflect the same metal that refiners pour and factories melt. But the $80 signals coming from China show that this link is weakening. On screens, silver still trades in the mid-20s per ounce. In Chinese shops and wholesale markets, reports show people paying 2 or even 3 times that level for actual metal. This is a classic decoupling. Paper and physical are no longer telling the same story. We have watched this movie before. In 2011, during the last big silver rush, futures hit almost $50, while some coin dealers charged heavy premiums and often had no stock anyway. The system looked fine on charts, but on the ground it was strained and patchy. Today's gap in China feels like a sharper version of that split. The current anomaly is that futures markets still act calm. Volumes trade as usual, margin rules have not changed much, and volatility is not extreme. Yet physical buyers in China behave as if silver is scarce and urgent. Someone is wrong. The open question is simple but serious. Are paper markets underpricing real risk, or are local Chinese buyers overreacting to fear and policy shifts? It is like watching a thermometer show room temperature while one corner of the house is clearly on fire. Just as the earlier price fracture suggested, this growing divide between paper and physical is another sign that stress is building under the surface of the global silver market. When prices jump this far above global levels, the first place to look is inventory. Are shelves and vaults in China running low, or is something else going on behind closed doors? Reports from dealers, small refiners, and some industry groups suggest that visible stocks of silver are thinning out, even while official data still looks fairly steady. In past crunches, this kind of mismatch has been an early warning. Before the 1979 to 1980 silver spike, exchange warehouses showed only a slow decline, but coin shops and industrial buyers complained about delays and partial deliveries. The same thing happened in copper during the 2005 to 2006 boom. Published stocks seemed okay, yet premiums and wait times quietly climbed. Today's red flag is the gap between what you can see and what you can actually buy. Some Chinese wholesalers report that common bar sizes are available on paper, but new orders face long lead times or strict quantity limits. It is like a grocery store that keeps the shelves looking full by spreading out the last boxes of food. Customs and trade figures raise more questions. Imports of silver products into China have not exploded enough to explain an $80 price, yet premiums still rise. That suggests either a hidden drain, such as large players buying off-market, or unreported movement out of official channels into private storage. The open question is whether this is true scarcity or strategic stockpiling. Either way, just as the earlier price fracture and paper-physical split hinted, the behavior of inventory now points toward a market that is quietly being squeezed from within. China does not have a free and open money system. Moving cash in and out of the country is tightly watched. Moving metal can be just as controlled. These rules can turn a normal price gap into a trapped, explosive one. In many markets, an $80 silver price would quickly pull in supply from abroad. Traders would rush to ship bars from London or Dubai, close the gap, and take the profit. But in China, capital controls, import rules, and licensing limits slow this process, or block it completely. The zipper that should join prices is sewn shut in key places. We have seen this pattern before. In 2013, when India raised taxes on gold, local prices often traded far above world levels. Legal imports dropped, smuggling rose, and the premium became a signal of trapped demand, not free trade. Earlier, during some phases of China's own gold boom, the Shanghai price moved to a steady premium when quotas and rules choked normal flows. The anomaly today is that silver's Chinese premium is far larger and more sudden than those slow, policy-driven shifts. Currency pressure adds another layer. With concerns around the yuan and the wider economy, silver may look like a safer store of value to many people and firms. Yet they cannot simply move funds abroad, so they crowd into local metal instead. The open question is whether policymakers will loosen controls and let in more silver, or accept the pressure and let the premium rise further. Like steam inside a sealed pressure cooker, this trapped demand links back to the earlier fractures and makes the risk of a violent release even harder to ignore. What is happening in China's silver market looks less like a random spike and more like the early stage of past metal squeezes. When you line up today's signals with history, the pattern is uncomfortable. In 1979, the Hunt brothers tried to corner silver. They bought futures in huge amounts of physical metal. At first, the move showed up as rising premiums and tightness at dealers, while official warehouse data lagged behind. Prices ran from single digits to nearly $50 before the system broke and rules were changed overnight. More recently, in 2022, the nickel market on the London Metal Exchange gave another warning. A massive short position met shrinking available supply. Prices exploded, trading screens went wild, and the exchange canceled trades to stop the damage. Again, the first hints were small: odd price gaps, stressed borrowing rates, and thin offers for real metal. The red flag now is that Chinese silver shows several of the same early signs: strong local buying, thin visible stocks, and a price that refuses to fall back in line with global benchmarks. Yet major exchanges and many analysts still speak as if silver is quiet and under control. The unanswered question is who, if anyone, is overexposed this time? Is there a concentrated short in global silver that cannot easily find metal if China keeps absorbing supply? Or is the stress mostly inside China's borders? Like a crack forming along the same fault line that caused past quakes, these echoes connect directly to the earlier fractures we have seen, and they suggest that today's $80 premium may be the opening move, not the final act. Whenever a market becomes tight in silence, someone is usually preparing for that moment, and someone else is walking into a trap. The question in China's silver story is, who stands to gain from $80 metal, and who will pay the price if the squeeze spreads worldwide? Industrial users in electronics, solar panels, and batteries need silver no matter the mood of traders. If they or their suppliers locked in long-term contracts at lower prices, they temporarily benefit. Competitors without such deals are forced to buy at painful spot levels. In past cycles, like the early 2000s surge in copper, smart manufacturers who secured supply early kept running while rivals had to cut production. Another likely winner is any state-linked group building strategic reserves. If Chinese agencies or large banks have been quietly taking physical silver while the world looked at calm paper prices, they may already control a key share of available metal inside the country. The red flag is that this buildup, if real, is happening while official messages still describe markets as stable. Speculative funds could also profit if they are long physical and short weak hands in the futures market, but they face a risk. If authorities change rules, as they did during the Hunt brothers squeeze, profits can vanish overnight. The open question is, who is on the wrong side of this slow tightening? Are there big short positions in London or New York that cannot easily secure metal if Chinese demand keeps absorbing it? Like a chess game where one player quietly controls the center squares, this hidden positioning ties back to every earlier signal of strain we have tracked so far. The key question now is whether $80 silver in China stays a local problem or becomes a global shock. Silver is not just a coin or a bar. It runs through solar panels, chips, medical tools, and power systems. When one large buyer nation starts paying double or triple the global quote, it pulls on every link in that chain. Global mine output has been flat to slightly falling in recent years, while industrial demand, especially from solar and electronics, keeps rising. In past periods, like the early 2000s, this slow squeeze showed up first as mild premium moves and longer delivery times. Today, China has skipped the mild stage and jumped straight to severe pricing. That is the anomaly. On top of this sits a tall tower of paper claims, futures, options, and unallocated silver accounts. These contracts promise metal, but not all of them are fully backed by bars in a vault. In calm times, that does not matter. When one part of the world starts grabbing every ounce, it matters a lot. If Chinese buyers keep taking physical silver at any price, traders who are short on these paper markets may have to race to find real metal. This is how a quiet, local premium can turn into a worldwide squeeze, the way a small fire in a storage room can bring down an entire warehouse. The open question is simple but heavy. Do we still have enough flexible, honest supply to bridge this gap, Or has the world built a silver system that only works when no one truly tests it? All the earlier signals suggest that tests may already be underway. Across this investigation, the same pattern keeps repeating. What first looked like a small local oddity in China's silver market now lines up with almost every classic warning sign of a coming squeeze. A price fracture that refuses to close, paper contracts drifting away from physical reality, inventories that seem thinner than they appear on reports, and demand trapped behind capital controls. These are not random events. They are parts of one growing stress line. History shows how this kind of line usually behaves. In the Hunt brothers' rush, in the 2011 silver spike, in the 2022 nickel crisis, tension built quietly until one final shock forced the truth into the open. At that point, rules changed fast. Weak players were wiped out, and normal prices did not return for years. The files do not promise that today's $80 silver in China will end the same way, but they do warn that the odds of a calm outcome are shrinking. The key unknowns now are speed and trigger. Does a sudden jump in industrial demand, a new policy move in Beijing, or a loss of trust in paper promises light the match? Or does a slow grind of tightness simply push more and more buyers into chasing real metal until the squeeze becomes global by default? For anyone watching from the outside, the lesson is simple. Once you see repeated signals like these, you are no longer early. You are standing in the opening scenes of a story that is already in motion, with the next chapters likely to be written not on price screens, but in the fight for actual ounces.